While most people were focused on stock markets, tech growth, and rising asset prices, many gold investors were paying attention to something else entirely: inflation, debt, currency risk, and long-term economic instability. For decades, gold has been viewed as a hedge during uncertain times, which is why investors often turn to it when confidence in the financial system starts weakening. Today, we will talk about gold investors saw this crisis coming. So, before we get started, make sure to hit that like button. Also, subscribe to my channel. 10. Most people think gold is old-fashioned until uncertainty appears. For years, gold is often dismissed as boring, outdated, or unnecessary. During strong stock markets and booming economies, many people see gold investors as overly cautious or even paranoid. After all, gold does not generate dividends, launch new technologies, or create explosive growth like high-risk assets sometimes can. But something interesting happens every time financial uncertainty rises. Suddenly, gold becomes important again. Economic crises, inflation, banking instability, currency concerns, geopolitical tension, and market fear tend to push investors back toward assets perceived as stable stores of value. And this is why long-term gold investors often seem calm during periods that make everyone else panic. They are not surprised by instability, because many of them were preparing for it long before it became obvious publicly. 9. Gold investors think differently about risk. Most ordinary investors think risk means volatility. If an asset price moves dramatically, they view it as dangerous. Gold investors often think about risk differently. They focus more on systemic risk, the possibility that currencies weaken, debt levels become unsustainable, inflation rises, or financial systems become unstable. This creates a completely different mindset. Instead of asking only, "How much can I gain?" gold investors often ask, "What happens if the system itself becomes fragile?" 8. Gold has survived every major financial system in history. One reason gold remains psychologically powerful is historical survival. Empires collapsed, currencies failed, governments changed, and economic systems evolved. But gold maintained perceived value across centuries. For gold investors, this history matters deeply. They see gold not as a modern trend, but as a long-term store of wealth that existed before modern financial systems, and may continue existing long after current systems change again. This historical perspective makes gold investors think in much longer timelines than many modern traders. 7. Inflation quietly pushes investors toward hard assets. One of the biggest reasons gold attracts attention during crises is inflation. When currencies lose purchasing power over time, investors often seek assets they believe cannot be easily created or inflated away. Gold's supply grows relatively slowly compared to fiat currency expansion. This scarcity creates psychological confidence during periods when governments increase spending, debt levels rise, or central banks print more money. Gold investors often believe that while paper currencies may weaken gradually, hard assets preserve purchasing power more effectively long-term. 6. Gold investors distrust excessive debt systems. Modern economies rely heavily on debt. Governments borrow, corporations borrow, consumers borrow, and financial systems expand around leverage continuously. Gold investors tend to be deeply skeptical of this structure. They worry that excessive debt eventually creates instability because debt growth cannot expand forever without consequences. Inflation, currency weakening, or financial crises often become part of those concerns. Whether someone fully agrees with this outlook or not, it explains why gold investors often position themselves defensively long before crises become visible publicly. 5. Financial crises change how people view safe assets. During stable periods, investors often chase growth aggressively. But crises reveal something important. Assets that appear safe during good times are not always safe during economic stress. Bank failures, market crashes, inflation shocks, and currency concerns change investor psychology quickly. Suddenly, preservation becomes more important than aggressive growth. Gold investors expect this shift. Many of them hold gold not because they think everything will collapse tomorrow, but because they understand that confidence in financial systems can change very quickly when fear spreads. 4. Gold is often about insurance, not excitement. One reason outsiders misunderstand gold investing is because they evaluate it using the same mindset applied to high-growth investments. Gold investors are usually not looking for explosive excitement. They often view gold more like financial insurance. Just as people buy insurance hoping never to use it, gold investors frequently hold gold hoping major crises never happen, but wanting protection if they do. This makes gold psychologically different from speculative investing. The goal is stability and preservation, not maximum short-term returns. 3. Central banks holding gold reinforces confidence. An interesting fact many people overlook is that central banks themselves still hold large amounts of gold reserves. Even in a world dominated by digital finance and fiat currencies, governments continue treating gold as strategically valuable. For gold investors, this reinforces the idea that gold still matters globally. If powerful financial institutions continue holding gold reserves during uncertain periods, individual investors naturally question why gold remains important at such high levels of finance. This strengthens the belief that gold still plays a meaningful role inside global monetary systems. 2. Gold investors prepare emotionally before crises arrive. One major advantage gold investors often have is emotional preparation. Because they already expect volatility and instability occasionally, they react differently when crises appear. Instead of panicking during inflation spikes, banking stress, or economic uncertainty, they often see these events as confirmation of risks they already considered possible. This emotional stability becomes extremely valuable during periods when fear dominates markets and ordinary investors begin reacting impulsively. 1. The real reason gold investors saw this crisis coming, they were watching the system, not just the markets. The deeper truth is that gold investors often focus less on daily market excitement and more on long-term structural risks. Inflation, debt expansion, currency weakening, geopolitical instability, banking fragility, and declining purchasing power are all trends many gold investors monitor constantly. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.